Good afternoon. This is Ben Keller, and on behalf of Sally Grossman and I, welcome to the Lathrop GPM webinar called Transferring Your Family or Closely Held Business to Family or Other Insiders. So if you've signed up for some other webinar or think you're supposed to be signed up for another webinar, that's what we're talking about, and you're more than welcome to stay. So thank you all for coming, and hopefully everyone's safe and during these times. This is unusual for both Sally and me because we usually do this where we can see everybody. In some respects, they may not have agreed to do it because I haven't had my hair cut in 90 days. So the fact you can't see me in my crazy hairdo is probably a positive thing for me and you. Although I am going in tomorrow morning at 9 o'clock to get it cut finally. So that's good. So I want to welcome you guys again, and a couple housekeeping items. Throughout, we welcome your questions. If you have them, you can use the chat feature for those familiar with how the webinars work. We have a staff of panelists on hand to help us with those. And we started this process, this concept, one, because of the changing times and the COVID experience, because there's opportunities for you to take advantage of, as well as the need to refresh what's going on. So we were doing this in several parts, and this is part one of a series. And part two is scheduled for June 24th by Steve Kuchad and Scott Mallon. So to the extent we can't get to your questions, they'll be able to field those. And we should have further presentations even beyond that, which will be forthcoming. So that's how to handle questions. The webinar is also recorded and will be available on our website with copies of all the slides on Monday. So you'll receive a follow-up email telling you how to deal with that. And we welcome you to share that, keep it, and do whatever you think is appropriate with our stuff. So without further ado, I'm going to start by telling you how I got into the transition planning world in the first place. I teach a class at Washington University in St. Louis called Closely Held Business and Succession Planning. And we are going to change the name of that, remove the name succession and put transition in there, because I think it's a more appropriate term for what we do. But here's how I got into it. About 25 years ago, I'm minding my own business on a Sunday afternoon, and one of my clients called me, for whom we did pretty good estate planning. We transferred a bunch of stock to nieces and nephews and kids, and there were 6 of them total. And I knew that there was some rift between the oldest son and the oldest daughter, but notwithstanding that, we progressed to do good tax planning. And I get a call to meet my client for dinner in St. Louis, and we did. And he had a couple other gentlemen with him, and they were psychologists, industrial psychologists. And he said, I got to try to get my family back together, and these 2 guys are going to help me do it. So they formed something called, what I never heard of at the time, called the Family Council. I was invited to join it. I refused for all the wrong reasons because I wanted to stay the corporate lawyer. But I attended meetings over time in various hotel settings with poster boards all over the place and general kumbaya sessions. And I was pretty in disbelief that the process would work, and I was dubious about it. But I participated, and I'll cut a long story short. After 2 years and a $400,000 of investment by them, you can imagine what happened. We ended up buying the daughter out. Father cut the daughter out of his trust. Brother and daughter still do not speak to this day. And I thought that was a colossal failure. And the father told me, no, Ben, that was a success from my standpoint, because I did everything I could to get these guys back into the right frame of mind. And I'm glad it happened before something happened to me versus something happening after I died. And it changed my perspective on this. And we changed our class at WashU from a more estate planning traditional class to the transitional class. And from there, I've sort of gone through the trenches with this kind of stuff. And if you'll show the first slide, please. It's really broken down into two phases: management transition and ownership transition. And I'm going to touch on both of those today. Part C and D will be for future reference. It's just impossible to condense really 18 weeks of my class into 20 or 30 minutes, but I'll touch a little bit on all that stuff. generally speaking, in terms of how we go about it. The COVID thing has created, again, opportunities and some possibilities. For every succession or transition plan that's out there, whether it's in the family context or the non-family context, they really need to be reviewed. One, there may be ongoing payments that are due that business can no longer afford. There may be senior or generations that have been bought out or think they're bought out and the economics aren't what they used to be, and they need to maybe get back into the fold, or the business itself may be in peril from an ongoing concern standpoint. We had a restaurant client, and restaurants have been hit particularly hard by this pandemic, and the restaurant was owned by two parents, and they owned the entire restaurant. There were two sons. They had multiple locations, but the sons did not get along. And we've been working tirelessly prior to the pandemic, and we're getting close to separating the businesses out and doing what needed to be done to avoid further conflict between the sons. And then the COVID hit, and ironically, everybody's getting along famously now, and they're sort of back in the fold. You hate to have a pandemic create family harmony, but it did in this context, and whether it lasts or not will remain to be seen. But we need to review the plans that are already out there, and then we need to take advantage of the opportunities that, from an economic standpoint, today is a bad day to talk about the economy since the stock market's down 1,200 points as we speak. But again, that's what really prompted us to want to do something in a series to get people rethinking about this who may not have thought about some of the stuff before. So I'm going to, again, spend some time on the management transition. I spend most of my time on the management side of trying to get the corporate hygiene in place and in order. I have found that, and I have objective data to prove this, that when the corporate, and I'm not an exit strategist, I'm not trying to broker the sale of the business. My hope is that it's not necessary. But if it is, doing the corporate hygiene and getting the management transitional stuff in place offers a strong degree of value to the enterprise. And we have objective data on that in the several businesses that we keep track of. We have been told by buyers that because we've had the transitional plan in place with things I'll go over in a few minutes, it's added at least a 15 to 20% premium to the purchase price. So if in fact sale is in order, doing some of the stuff we're talking about does make some sense. The first item that obviously needs to be reviewed is, and this is, go to the next slide, please. This is a assessment analysis. And I used to hate that term, but I've now used it very frequently. We've got to make sure we can assess who it is, what the expectations are of this transition plan. Not every business can be transitioned. There aren't necessarily players and process that can take over what can happen, but we need to make sure that we have and communicate what the expectations are to our key team members. So identifying who those key team members are is vital. And some people who think they're key team members, we may not, or you may not think they are, and we've got to figure out how to wrestle with that so we keep everybody on the right page. The written plan is very important. I don't care if it's a page long or 100 pages long, but having something that people can look at and see is a very important part of this process. Not easy, and it takes some time, but it's important to do. And again, from a timing standpoint, you can't get a call on Friday to fix my transition plan and then hope it's done by the following Friday. This is at least a year, maybe 18-month process. And when earlier you start it, the more valuable the business becomes generally. And then having a commitment to this thing, and I try to assess that. I've got to make sure that the folks that say they want to do this are really committed to this, because if they're not, it's going to fail. It does take some time. There are some bumps in the road, typically things you don't expect generally, and we'll get to how that comes about in a second. So next slide. So on the detailed plan, and I'm going to hit the highlights of several of these things that I do. Again, we've got to make sure we have a good organizational chart. For every meeting I have, and I try to do them quarterly, the first thing we look at once a year is the org chart. My original comment in my class about org charts is that I had my three brothers who have a great business who had 6 kids, and they were all going to come into the business. And I said, well, okay, let me see your org chart. We were at a restaurant having dinner, and didn't even know what I was talking about. We don't have an org chart. Everyone just comes to all 3 of us. They had a horizontal org chart where the 3 of them were sort of co-equals. And I said, all right, well, tell me where your kids are going to fit in. So we took a napkin, I kid you not, because I never bring paper or pencil to my dinners. And we drew an org chart. And one of them said to me, oh, I see where this guy's going with this. Because they didn't have room for 6 people. And in order to accommodate the 6 kids, which was very important, all 3 of them, we had to buy a division. They had to start a new division, which, by the way, is that was 8 years ago, which is now the strongest division in their company. And all the kids have been accommodated. So we've got to make sure that we have an org chart that defines who does what to who. And I can't express this enough, so I'm going to spend another minute on it. I have 2 brothers who, different company that run an organization, and they've been doing it for 50 years. It's hard to fill 50 years of experience in an org chart. The box below them has been unfilled for 6 years. We still can't figure out who it should be. And frankly, the person who we thought it was going to be was another brother. He's no longer employed by the company. And so they've continued to operate on a horizontal basis as well. So we've got to have an org chart, and we've got to have decent job descriptions. Somebody has to be responsible for taking out the garbage. And even in my own firm, we had a rule that whoever got to the office first brought newspapers in that were in the lobby. Well, we had an assistant that didn't think that was part of her job description and never did it. So she's picking up newspapers someplace else now because that was her job. And again, getting these job descriptions agreed to by everyone. So I asked the people whose job we're trying to describe, write them for us. And then management will look at them, and we look at them. And that's how we judge objective criteria on who's supposed to do what. And we've got to make sure we've got all bases covered. Someone's got to be, and then they are also helpful for the transition plan. We have a job description and say, this is what we're trying to fill. Who's going to fill this position when someone gets to the station in their life where they're either going to retire or move on? So job descriptions and the org chart are very essential to what we need to do. Mission statement, you'll see, is also important. I've written many, many mission statements, and it's more than we want to provide good services at a fair price to our folks. It has to have some social context to it. It has to have an environmental context to it, but it has to be well thought out, because when people look at your website from a business standpoint, that may be the first thing they see. Commitment to your people is a very important objective standard for outside folks looking for vendors. They want to make sure that the people are going to be long-term, they've got a plan in place, and it's also important from an HR standpoint to keep the employees interested in knowing that, hey, this organization really does care about me, and this is, I'm part of the mission. And every once in a while, you review the mission statement and ask for input. Sometimes it needs to be tweaked as well. On goals and objectives, I'm a big fan of this. And again, I didn't used to be, but I've morphed over time to understanding the benefit to doing these things. And it's both financial. It's easy when you're talking about sales. We want our sales to be X. We want our sales to be X plus 12% a year, whatever it may be. But it's more than that. It's individual objectives. In service businesses, maybe it's to have a few, if any, complaints to make sure that we follow up. Just objectives on how we're going to achieve our whatever our mission may be. And those goals and objectives are reviewed, obviously, once a year to see if we've met them. We are very, in the plans that we implement and try to be as pristine as we can, we try our best to make sure that we evaluate those, and we have self-review forms. Most people are harder on themselves than the management is, frankly, and that's good, but it also is important that people also are able to assess their own performance and tell us where they may have fallen short and why they didn't get to where they needed to get to. Budgeting is a big part of this. When we do budgets, and I'm a big fan of those, obviously there should be a fatal budget, there should be a realistic budget, and then an optimistic budget. I have fights all the time in a friendly kind of way on trying to get that stretch budget done, because everyone wants to outperform, not underperform. But in my experience, whatever budget numbers we set, those are the numbers we try to go for. So we need to stretch a little bit. And again, I can quote line and verse where we've done it. And we don't always exceed the stretch budget, but we're typically above the other budget, or what the expected budget is. So again, people need to be held accountable. And there are things that happen. This COVID thing's a perfect example of that. Budgets have been shot in the heart with respect to how they are perceived and revised. Our own firms had to revise our budget a couple of times as well because of the nature of the outside forces. So I'm a big fan of goals, both personally, what someone's personal objectives are, looking at the org chart. You know, I'd like to be promoted to this job. Can I be promoted to this job? Is there a future here? Again, from an organizational behavior standpoint, we're trying to manage, from a management transition standpoint, we're trying to keep a core group of people together the best we can. And in connection with that, number 5, which is the strategic meetings, are very important. So I try to interview, more than try, sort of require it, interview the key people so that I have the opportunity to hear what they think. I limit these interviews to 15 minutes, never more. People sometimes want to spend all day with me, and I limit it to 15 minutes with pre-described questions that I deliver to them about whether they think the patriarch or matriarch or leader can transition. Is there anyone there who can actually take it over? And I had a mom who had a son working there with 5 other non-related key people. When I interviewed the 4 or 5 key people, they all thought the son couldn't do it, and the son was the only one that thought he could do it. And I had to remind everybody from an ownership standpoint, it's pretty obvious where the company was going to go. And the son rose to the occasion, and he proved the other 5 or 6 people wrong and took over, and they're getting along. But it took that interview process for me to figure out where everybody stood. And you know, once that is set and we can share those results with everybody, it gets everybody on the same plane. But it's proven to be very important. So that, it's confidential unless someone tells me they're going to quit or hurt somebody. But it's been very helpful because people can't always tell their parents or can't tell their uncles or can't tell their bosses, even if they're unrelated, really what they feel, but they feel more comfortable saying it to me. And again, I'm not a psychologist. I've got my degree in that from the School of Hard Knocks, I guess, but it is helpful for me to conduct those interviews, generally speaking. Next slide. So once the interviews are done, we sort of figure out what we're going to do and how we're going to go about it, and make sure that everybody is as comfortable as they can be with what the plan may be. If no one is an heir or heiress apparent in the organization, we may need to look outside the organization. And again, having key restrictive agreements for our key employees is pretty important. Confidentiality, whether we need non-competes is something that needs to be discussed. If we don't need them, we shouldn't get them. They are enforceable in most places, especially in the context of what we're trying to achieve. But we need to have confidentiality, non-solicitation of customers and vendors and employees. And if we need a non-compete, we may need to add those. But having those agreements in place prior to an exit event or liquidation event or liquidity event is very important in terms of adding value to those. In order to keep some key people in terms of their evaluations, a lot of times we need to give them deferred compensation arrangements, something to incentivize them. There are documents that I typically would attach to this outline if we're all together. One of those would be a phantom stock plan. I'm happy to share that as part of the outline if you guys contact me. That's one of the handouts that is not part of this, but could be. Again, just describing what phantom stock is as an incentive, as a deferred comp plan for key executives. We want to keep our key people as long as we can because we're investing in them. Who should be in the room? It's a very important discussion. We have significant discussions about corporate governance, the differences between directors, and this is in the corporate context, directors, shareholders, officers, employees, and creditors. Sometimes a person can be all 5 of those. Sometimes they're one of those. Sometimes there's a mix. But understanding the distinction among those various roles is very important for the ongoing transition of the company. I have all sorts of family folks who think they can fire their kids as an employee or a key person as an employee when they're on the board or they're an officer, which requires looking at corporate documents, bylaws, to make sure there's a procedure to do it. Again, we want to keep all that as upfront as we possibly can. The catastrophe plan. I can admit to you that I've never done a catastrophe plan that ever thought of a pandemic before. And I have a sample catastrophe plan. Again, I'm happy to share with you guys. It's really pretty personalized though, but what it has on it typically is where to find the codes, where to find the passwords, who to contact at the bank or the lending institution to the extent there's a line of credit, so our lenders don't get nervous if something untoward happens to the leaders of the company or the owners of the company. What the message needs to be, that we've got this in place to the employees, to the press, and that we're an ongoing concern and there's nothing to be worried about because we've already talked about this. Now, the catastrophe plan is something that definitely needs to be reviewed. It's typically a 1 to 1.5 page document, but now it's going to have some different stuff in it because contracts that we might have had, leases that we might have had, if this were to happen again or if it goes long term, what are the consequences? Should we renegotiate our lease when it comes up to provide, what if another pandemic comes? Is that an extreme position to take? I've dealt with several of my friends' kids who are getting married this summer, who've had their weddings at various venues. And of course, there were no specific clause. You guys may have heard the term force majeure, or a provision that says if by impossibility, hurricanes or something happen, you can't perform the contract, you get out of it. Whether force majeure applies to a pandemic and a wedding, we've worked it all out with all the venues in terms of postponing those and moving along and not losing deposits. But again, from a catastrophic standpoint, is that something that we need to look at? And if we're revising our leases or our contracts that are long-term, do we need to provide something in those arrangements that deal with those contingencies? I think the answer is unknown to that, but everyone's sensitive to it now because we're living through it and we really don't know how much longer it will ultimately last. So we need to be cognizant of that. SWOT analysis. Big fan of this too. Strengths, weaknesses, opportunities, and threats. And I strongly urge everyone to do that. We do it in our own department. We try to enhance the strengths. We try to lessen the weaknesses and take advantage of the opportunities, but we've got to be cognizant of what those are. Obviously, a threat to the restaurant business, which no one ever anticipated, was some pandemic running through the United States and the world, both from a supply chain standpoint and the rest. So these nuances really do require you to take a hard look at the business and what might happen out there. I wouldn't overanalyze it, but it's just something to take into account, because for those who are trying to transfer their business, especially in the family world, you don't want to strap the kids into something that they never thought about and never had to, or they're thinking about it differently now that they're living through it. Lending, for example, we don't transfer control of most entities while the senior generation is on the personal guarantee for obvious reasons. Who knows whether we'll be able to do that or not, but it's something that needs to be looked at. And sometimes the people are the biggest strength. And if that's the strength, we need to make sure that we've got some incentive to sort of keep them interested in what goes on. With respect to the people part of it, I won't spend a lot of time on this because I'm going to spend a few minutes on the ownership stuff, but intergenerational work relationships are very important. And again, I can spend an entire, and if there's interest in this, we can obviously have a separate webinar on this topic alone, and I would need some help from the employment people. But there are differences in generational beliefs in terms of the traditionalists, which are the older generation, and then there's the baby boomers, the Gen X folks, the millennials, and the Gen Z folks. So all I'll say is there are differences and nuances among all of those. Most of our younger folks in our office find working from home and remote a piece of cake. Some of the older folks, we're getting used to it, but it's not the same as being in the office. And again, understanding that nuance, especially when things like this happen, I think are very, very important to deal with. Next slide. Last thing I want to mention among these various things that you can look at yourself is the advisory board. We have found it extremely beneficial to have an advisory board. And the advisory board, you got to decide the makeup, how many people to have. It's not an official governing body. It's just an advisory type thing as per the term, to give some insight, some experience, someone who's been in the industry, perhaps someone who's been in the industry, who's retired, or who's actually transitioned their own business. How they make decisions, how often it meets. But a lot of times when you can bounce ideas off of that advisory board, it helps the owners and the real board members have an independent assessment as to what's going on objectively. So I strongly urge that review, generally speaking. Okay, next slide. Ownership transition, second piece of this. I'm going to hit a couple highlights here. There are many ways, and Sally's going to talk about this. I'm going to talk about the more of the psychological part of this that folks don't really think about. Again, there are many ways to do it. There's tax considerations that go in about it, generally speaking. If we have the management piece in place, if we've done everything that I've listed above the best we can for the organizations that we're handling, the ownership transition makes a lot easier. I would never do, even though it happens more often than not, where we transfer the ownership part piece of this when we haven't done and gotten the management piece done. I think that is a mistake. I think you need to get the management piece in place and then deal with the ownership piece. Two things to note. One is divorce. A lot of times families want to sell their business to their kids in Missouri and other states. Once it's sold, it becomes marital property, and is half that business in the case of a child's divorce will go to the divorced spouse. So sale is not always an option. There are ways to do it as long as it's handled correctly. So I caution you in terms of how we go about doing it. Marital issues do come into play with that. And then valuation. It's an art, not a science, and I can spend, again, to the extent there's interest in this, I can spend an entire time frame on valuation. I will tell you that we've developed a Excel spreadsheet here that's very easy to use, and I'm happy to share that as well, to make sure that we test valuation. We're not valuation, we are experts at it, I think, but not in the sense of appraisers. But we can double check and give it the litmus test type mentality by putting numbers into the spreadsheet, using multiples. We have add backs to normalize it for salaries, for extraordinary events, charitable contributions, things that make, so you can get an idea of what number we're looking at in terms of value. So it's an art, not a science, and it's something important. And we can't always poor mouth our way to the result we want because the business does have a going concern value. The other thing is that equity itself, generally speaking, carries with it the right to inspect the books and records. I have had family businesses not transfer to their children because they didn't want all the kids to know what the other children in the family were receiving by way of compensation. It may seem odd, but again, those are the things you learn from experience by doing this stuff, that was an important enough deal, knowing that it would cause a rift, even though the kids already knew it and the parents didn't realize that. But the fear itself was enough for them to want to sell the business. One last thing I'll mention is I also have what we call the family code of conduct. It doesn't need to just be for the family. There's no consequences. There's no penalty provisions, but I try to have all families sign that code of conduct. It basically says to be nice to each other if you can be. No communications by emails other than business stuff. No communications by text messages, but the old-fashioned way of either picking up the phone or actually walking 45 feet and going into someone's office and having a conversation with them. And when people sign it, at least I can pull it out when bad things happen. I've been in meetings where federal marshals have had to be there and everybody but me was packing since I've never shot a gun. That was a nerve-wracking experience, but that was the way this family operated. They, of course, never signed a family code of conduct. But we just have to be prepared, so if we can get that signed, hopefully it'll quell negative input. Sally, I'm going to stop there and turn it over to you for your good words, and thank you guys for listening.
Great. Thanks, Ben. Thanks for that great overview of the management and transition issues. And as Ben said a couple of times, we could probably go all day on lots of these subgroups. So this is a whirlwind tour. I'm going to assume that you followed the process that Ben has outlined and you're now ready to get your business to your successor. That could be a family member, it could be a key employee, it could be another owner, whatever. I'm going to call that group insiders. I want to talk about how you do that in a few minutes, but before I do that, I want to spend just a minute and have you think a little bit about what I call your why. Why are you transferring your business to an insider instead of to an outsider? And by that, I mean sale to an unrelated, uninvolved third party. As Ben mentioned, we got a couple of partners who are going to speak in a couple of weeks, and I think they'll focus more on that outside transition. And there's nothing wrong with that choice if that's the right choice for you. But here we're assuming you're at least considering a transfer to an insider. So before we talk about how, I want you to think about why you would transfer to your insider. I've got a poll here, and these are maybe not all the reasons, but I'll give you just a few minutes to give us the most important, number one reason why you would transfer your business to insiders. When you do that, I believe you should see a right on your screen. Don't be shy. All right, if we don't get any answers, I'm just going to run through some of these. Oh, wait, there they are. Okay. I don't know if everybody's had a chance to weigh in, but I think we've got enough information. You can all see this. 68% say to provide an opportunity to your family. The next most important is to keep the business intact. And then we have a scattering of other reasons. And for some of you, you might have had a hard time picking the number one reason, because in my experience in working with owners, there's often more than one reason. You may want to provide opportunity to family, but you also don't really want to sell and see somebody slice and dice this business for a lot of reasons. It's your baby, you grew it, you've developed it, you've watched it grow, and you don't want to see it die. So there are a lot of really good reasons to transfer to insiders. And I think as we continue and look at some of the how do you do that, it's really important to keep in mind your personal why. And the reason is I might talk about a good technique, but that technique might work best for somebody who's transitioning their business by sale to an employee. And if your hope is to be able to gift it to your kids, then the great technique I'm offering is probably not the right one for you. So let's make sure that we match the tool you select to your business. I want to talk a little bit about beginning with the end in mind. And as Stephen Covey used to say, be sure your ladder of success is leaning against the right wall. And that is the joining up of what you're doing, why you're doing it, and how you're doing it. So I'm going to go through just a few of the tools we have available here. They're not all of the tools that are available to transfer your business. I've got an outline that covers 5 different transfer tools, and I'm happy to make that available when you log in a couple of days on our website. It'll go through each tool, what it is, how it works, its advantages, its disadvantages, and its effect on control of the business. And I'll also tell you why it's working so well now in this COVID environment. I won't have time to get through all of that information today, so I won't even try. What I want to do is tell you what those are. Next slide, please. So the tools that we're going to talk about, and we'll focus mostly today on buy-sell agreements, with some time spent on the GRAT, and number 5, the IDGIT if there's time. I'm not going to talk as much about gift and installment sale, although those are 2 of the very common transfer techniques. Let's go to buy-sell agreements. Most of you probably have a buy-sell agreement. You might call it, if you're in a corporation, something else like a stock purchase agreement. Maybe you call it a redemption agreement, a shareholder agreement, or sometimes it's even called a buy-sell agreement. If your business is an LLC, it's probably found in your member control agreement or possibly your operating agreement. If it's a partnership, it's probably contained somewhere in your partnership agreement. But I'm going to say buy-sell agreement, you'll know I mean all of those. And similarly, I might talk about shares or stock, but you'll know that that includes your member interest in your LLC or your partnership interest. Next slide, please. So what is a buy-sell agreement? It can be really simple, it can be complicated, but the basic concept is it's between the owners themselves or it's between the owners and the business, and it provides for the transition of all or part of an owner's interest upon certain defined events for a predetermined price and terms. Why do you care about this? Well, as we've got on the slide there, it's the only way to bind the other owners. Now, if you think about what happens if something happens to one of your co-owners right now, Let's say they get COVID-19 and they don't make it. Do you want to be in business with their spouse? What about with their kids? Do you know what their estate plan says? Probably not. And what about an ex-spouse? If you don't want to be in business with your partner's spouse or kids, you for sure don't want to be in business with their ex-spouse. The buy-sell is the only way that you can tie this up. I can't tell you how many times, and I'm sure Ben has seen this too, I see a well-intentioned owner who gives equity, full voting equity, maybe a small slice, to a key employee to incentivize him or her. And that can work really well, but they don't get a buy-sell agreement. So what do you think happens to the ownership in your business when that person leaves your employment? It goes with them. You need to tie that up. Now, what you cover can vary. I mean, there are other purposes. I've got, estate liquidity. Sometimes what you want to do is make sure that there's money in the estate of a deceased shareholder to be able to pay the taxes. The buy-sell can also provide an exit strategy on an owner's retirement, disability, leaving employment, etc. So there are a lot of reasons, but I would say if you only remember one thing about buy-sells here, remember, if your business has more than one owner, you need the buy-sell to control who you're in business with. So how does a buy-sell work? Next slide, please. The agreement generally starts by prohibiting all transfers. That's the general rule. And then there's usually an exception to that rule. And that exception is often something like you can transfer with the consent of all, prior written consent, say, of all of the other owners. Or maybe it's a supermajority, but there's some out, but it requires you to go through some hoops. And then again, I think because we're lawyers and we like to be smart, no, I'm just kidding. Then there usually are exceptions to the exception, and that's often for something called permitted transferees. A real common one is to allow a transfer to your revocable trust. And a revocable trust is basically an alternate estate plan. It's a will substitute. And under the law, it's considered an alter ego of the owner. So I would say most modern buy-sells will have a provision that allows a transfer to an owner's revocable trust. Sometimes there's other transfers for marital trusts for spouses, for key estate planning purposes, but that needs to be very customized, what you allow and what you don't allow. Generally, you want to make sure that those permitted transferees, though, can't make further transfers, and they are bound by the buy-sell agreement. So you open up the door a little bit, but you don't want to let everybody out. The buy-sell agreement will usually have what we call trigger events. These trigger events say when the agreement applies. Generally, they'll apply to things like death, very common, disability of an owner, termination of employment by an owner who is employed by the business, attempted gift or sale during life, and almost always bankruptcy, divorce, or other involuntary transfers by the owner. Not all agreements cover all trigger events, and these are probably not the only ones, but you should use trigger events that fit your circumstances. So for example, if you're in a family-held business and all of your owners are family members, you might not care if somebody continues to have ownership even if they're no longer employed in the business. On the other hand, you might feel differently if you got that non-employee member in a family business who suddenly leaves. You might want the right to buy that stock back. If you're a closely held non-family business, you're unlikely to probably want former employees owning stock. But again, you might have an exception for your founder. So your trigger events should be tailored to your particular situation. The buy-sell agreement also specifies who buys in what order. Next slide, please. There are basically three types of agreements. The first is a redemption agreement. And a redemption agreement is one where the company is the buyer. And this can make a lot of sense. Lots of times there's insurance on the life of a shareholder, and on the death of that shareholder, the company gets the proceeds and intends and does use them to make the buyout. That can also work well if the company's got some kind of sinking fund and they've planned for the redemption. But on the other hand, there can be times when a redemption really has pretty unintended results. Let me give you an example. Let's pretend you are Joe. I always call my anonymous people Joe. You own a business with your brother John, and he's just an inactive investor. You own it 50-50, but you've got your son Joe Jr. in the business who's working in there, and eventually you think, both you and John agree he'll probably take over. So you want to incentivize him, and each of you, maybe John sells, and you give 20% of your interest to Joe Jr. So to make my math easy, if there are 100 shares outstanding, now after that transaction, you own 40 shares, 40%. John's got the same interest. And Joe Jr. owns 20 shares or 20%. And let's say your buy-sell says that the company has to buy on the death of a shareholder. You get COVID-19 and you die. Sorry, but my example doesn't work if I kill off John or Joe Jr., so I got to kill somebody off here. The company buys the 40 shares from your estate. Your shares disappear. When the company buys, they sort of disappear and everybody else's ownership interest goes up. So there now are 60 shares outstanding. What happens to ownership? Well, Joe Jr., your active successor, he now owns 20 of 60 shares or 1/3. Not bad. But wait a minute. John, your inactive brother, owns 40 of 60 shares, which is 2/3. So now you've set up a situation where your active successor is beholden to an inactive investor in running the company. And even if they get along really, really well, you've put them in a position where their interests could be opposed. Their goals, their objectives, their expectations from the company could be very different. Joe Jr. maybe wants to expand. He draws a salary, he's got benefits, he can go on trips. He's interested, he can draw value out of the company, and he's interested in expanding, maybe investing in some new plant and equipment, taking on some new debt, and all in hopes of a greater return down the road. John, by contrast, probably draws no benefit from the company other than the dividends or distributions, and he might have come to rely on those as his return on his investment. He might not be so eager to expand. So the problem here is that the buy-sell doesn't fit the succession plan. Nobody bothered to ask the right questions and amend the structure of the agreement. Instead, somebody just amended the agreement to add Joe Jr. as an owner and get his signature if that even happened. So remember that redemption agreements can be great, but it needs to be tailored to fit your circumstances. The second type of buy-sell agreement is a cross-purchase agreement. In this agreement, the other owners, instead of the company or the entity, buy out the departing or departed owner. Generally, they do that in proportion to their respective interests in the entity. An advantage of this in C corporations is that it can give the other owners, the buying owners, increase in basis in the purchase stock as opposed to a redemption agreement where that doesn't happen. One of the disadvantages I see with cross-purchase agreements, however, is that if you're trying to fund with life insurance, you've got to have each owner owning a policy on the life of each of the other owners. And if you've only got 2 owners, that's not so bad, but you start to get 3, 4, 5 owners, and the logistics of this are kind of a nightmare. And the other problem is when one of those owners dies, owning policies on his or her co-owners, we want to get those across to the other remaining owners because they're going to need them to purchase the next person out, right? And one of the challenges is that the transfer for value rules under the Internal Revenue Code can make it very difficult for us to move those policies around. We either have to have a purchase for fair and adequate consideration, or we've got to have a transfer to a proper party. And most people are surprised to learn that your fellow shareholder isn't a proper party. So it can be challenging. The cross-purchase agreement is kind of the life insurance person's dream, maybe, and the buy-sell succession planner's nightmare. The third type of buy-sell is a hybrid or combination approach. I kind of like this one the best because it's the most flexible. I call it a wait and see buy-sell. It allows us to defer deciding on the actual purchaser until the time at which we have better information. And we can wait until the trigger event occurs, then we can see who's the best purchaser, who can come up with the money to buy, and so on. I might structure a hybrid buy-sell to offer first an option to the entity to buy, but if it doesn't buy, then the option passes to the remaining owners pro rata. Or I might flip that on its head and I might give the first option to the other owners. And then the option might pass next to the entity. In my Joe, John, and Joe Jr. case, I think what I would probably do is have an option on Joe's death and maybe even on John's to Joe Jr. first, then to the other owners, then to the company. Sometimes the last option is mandatory, sometimes it's optional. And when it's optional, then the transferring owner is free to either give or sell his or her shares, or the interest passes by the estate plan of the deceased owner. As an aside, let me just mention, you need to really coordinate your estate plan with your buy-sell agreement. And this isn't an estate planning webinar per se, but as someone who comes into succession planning, starting with the estate planning side, I see a lot of disconnect. You might have your will over here and your buy-sell agreement over there, and maybe the will was done by your longtime family lawyer, and your buy-sell was done by company counsel, or the first lawyer helped you incorporate your business, however many years ago that was. And the 2 documents don't talk to each other. You need to have documents that are coordinated. You need a coordinated plan, and you need to be working with a team that understands that. Okay, so back to buy sells. What else does buy sell do? Next slide, please. It should set the price. And I see a lot of buy sells that have what I call a sweetheart price. Often it's book value, sometimes it's a multiple of book, sometimes it's an adjusted book value. No, 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 no. Usually your book value is not close to fair market value. You're carrying your real estate and your equipment probably at cost, not at market value. You've depreciated the heck out of everything you can depreciate. When you use book value and it's way below fair market value, you have a lot of problems. For one thing, it hurts the family of the deceased shareholder or the selling shareholder. Now, you might not care in certain situations, like a divorce. You might want to buy the ex-spouse out at a really lowball price. But you might feel differently about your business partner, spouse, and kids. For sure, I can guarantee you're going to feel differently if you all of a sudden realize that the estate that could be getting bought out at a really sweetheart deal is yours. So below market prices are great. News flash here if you're the buyer, and not so great if you're the seller. The buy sell should be entered into at a time when nobody knows which side of the deal you're going to be on. So the other problem with a lowball value, and this only applies if you have to worry about estate taxes, but we've got historically high exemptions right now, over $11 million a piece. If there's a change in control in the legislature, that doesn't seem likely to last. It's not supposed to last after 2025 anyway. So you might in the future need to think about estate taxes. That buy-sell agreement in a family business with a lowball value is not going to bind the IRS. There are a bunch of rules around this, but basically I'm going to tell you it's not going to bind the IRS. The IRS is going to tax you at fair market value. And now you have a situation where the cash coming in on the purchase is at your sweetheart price, and you're paying tax on the regular higher price. And that could create a big liquidity problem. So what I usually like to use is a series of prices, and you'll see these on the screen. And the first is an agreed value. If the parties can agree within a reasonable time after a trigger event, then I think it's fine that they agree. If they can't, then we go to what we call the stipulated value. And you may have seen these, or your agreement may have it, where the shareholders are supposed to get together once a year and set the price. That happens, take a look at your corporate minute book. When did you last update the minutes? Right. But some companies are really good about doing it every year. And if that value is not too stale, then we'll try to use that. Often though, however, the value is stale. It's either over 12 months or 15 months, or with some companies, some buy-sell agreements will say 18 months is stale. But there's some time period in a well-drafted buy-sell that says, no, we are not going to use that price anymore. It's just too old. They didn't get around to fixing it. Then we'll go to appraised value. I like to use appraisal. I think it's your way to get to fair market value. And I also like to specifically direct the appraiser whether or not to take into discounts for lack of control, minority interest, and discounts for lack of marketability. And the use of discounts is kind of implied in the term fair market value versus fair value, but I like to put that in there in the drafting stage. I like to call out that question because that makes my owners think about what do we want to have happen? And again, am I going to be the buyer or am I going to be the seller? You might want to discount in one situation, you might not want to discount when you're on the other side of the fence. In addition to setting price, your buy-sell will set the terms. You can see those there. Down payment might be 0 in some situations, 5, 10, 15, 20. Your installment term might maybe be all cash at once. Usually there's an installment payment. It might be 5 years, 10 years. Maybe in a family business, it's 15 years. Do remember that the longer the term, yes, it's more affordable for the buying party, but for the seller, 1, they're deferring recognition of the income, and 2, they're kind of joined at the hip with a business that they were trying to get out of. Interest rates. This is a big one. Try to use something that moves somewhat with the market, whether you use prime or 2 points over prime, your line of credit rate, some formula tied to the market. Don't just use a fixed rate. I still see buy-sell agreements that are using 8%. I mean, that's a great windfall to somebody, but it's way out of market. The buy-sell agreement should talk about your use of insurance proceeds. And I mentioned earlier that if the company or the shareholders own life insurance, it's pretty customary to require that those proceeds received on death, if the purpose of the policy is to fund the buy-sell, be used as the down payment up to and not exceeding the purchase price. But sometimes, especially the company owns other policies that really weren't intended for the buy-sell. So you may have just pure key person insurance that you were going to use to replace, kind of get you through the rough spots if you haven't done good transition planning when your owner dies. Or you may have policies that are collaterally assigned as security for various loans. So make sure that the language about your use of insurance proceeds ties in with your particular policies and the purpose for your policies. You may or may not want to require that certain policies be used as the down payment. Okay, that's a whirlwind on buy-sells. They're clearly very, very important. They're not the only transfer tool, but I would say that they are probably one of the most important, certainly in the closely held business and even in the family context. There are two things you should do now. The first is if you have more than one owner and you don't have a buy-sell agreement, you should get one now, yesterday. If you have one, I'd suggest, as Ben mentioned, with COVID, we really need to rethink some things. You need to pull that baby out and dust it off. Ask yourself some questions. Is the price still right? What you were willing to pay maybe on your stipulated value a year ago is not what you would pay now for your partner's interest in the business. And what about terms? It's a changing and challenging environment. Maybe you as a seller don't want to hold another person's paper for as long as, say, 10 years. Or maybe as the buyer, you're not willing to put as much cash down as you would have before the pandemic. What about your interest rate? If you have a fixed number, it's definitely too high if you're the buyer. And what about your funding? Does the buy sell itself or the other owners have the ability, does the business itself or the other owners have the ability to make a purchase right now if something happens to one of your other owners? Because that's going to be unexpected, right? So even with today's business depressed values, your buy-sell is still got to fit what your current situation is. And the business is probably worth more than what you started at, even with the depression here. Think about what kind of funding mechanism do you have? So if you purchased life insurance when you first started the business and you haven't looked at that again, you've probably got a big liquidity gap. We're in a world where cash is king. Are you really going to want to take cash if you don't have life insurance and tie it all up in buying out your partner's estate or your selling partner? Maybe not. So look at the structure of your buy-sell too. Remember my Joe Jr. example. Don't put your successor in an untenable position. If you haven't looked at the structure of your buy-sell, since you've made some of these succession decisions, you may not have those two things matching up. So dust that thing off, think about how it would work in today's crazy environment. Okay, in the time I have remaining, I'm going to just give you a quick overview of a couple of transfer techniques. The first is gifts to family. That's usually not done to unrelated parties. And also sales on an installment note that can be to either family or other insiders. I'm sure you're familiar with those techniques. The one thing I want to mention is that both of those techniques work really well right now. The depressed business values are going to make it easier to give more of the business for less consumption of gift tax credit. And it's also eases the unfairness to the other children. That makes it easier for you to equalize with other assets. Depressed values also make it easier for your insider to afford to buy the business now. And the low interest rates make the payments more affordable. If you were thinking of gifting or selling your business on a note and you can stomach receiving the lower value on the note, now's the perfect time. I would not wait. I don't think rates are going to go any lower. Berenstein just came out today with their predictions for next month, and they're predicting no real change in the short-term or mid-term rates, applicable federal rates, or what's called the 75/20 rate. But they're predicting that the long-term rate, so anything on a over 9-year note, is going to increase maybe 23%. Again, only to a whopping 1.24%, but it's only 1.01 this month. So if you're looking for rates to go lower, I wouldn't do that. I have a couple of other more sophisticated techniques. Next slide, please. One is a grant or retained annuity trust. You can kind of see it's an irrevocable trust that can't be changed. You transfer your business interest to the trust and you take back an annuity. Next slide, please. I'm not going to go through all of these. It's a little bit more sophisticated technique, but basically you're making, it's a gift play. You're just leveraging the use of your gift tax credit. The business will continue to make distributions to the owner, and then those funds will kind of do double duty because the trust as an owner will then pay you as the prior owner an annuity for a certain period of time. You do continue to pay the income tax in the business during the term, and then the trustee can distribute income and principal to the trust beneficiary. Next slide, please. This is a pictorial for those of you like me who I like to draw boxes. These are way straighter than I draw in meetings, but this kind of shows you pictorially how the GRAT works. And often we'll do GRATs for a short period of time, and then you'll take the annuity from one GRAT, they're called rolling GRATs, and you'll just put it back into another GRAT. The whole play is that if you can beat what the IRS assumes the business is going to grow at, that excess income is that excess growth is going to pass gift tax free to your successor. Next slide, please. So I won't point out all of these, but the biggest one is that the business growth over what I call that section 75/20 rate passes gift tax free. And the 75/20 rate is 120% of the midterm applicable federal rate. So right now for June of 2020, it's 0.60. The annuity provides you with a little bit of a safety net, and the income tax paid is a tax-free gift. If you're somewhat risk averse, it's also a technique that's blessed by statute. Next slide, please. There are a couple disadvantages if you don't survive the term. This is why we use 2-year terms. If you don't survive the term, a portion of the property comes back into your estate. So you kind of lost the bet. You're out the transaction costs. You're also paying tax on income you don't receive. And I know I said that was an advantage, but when you're writing that check to Uncle Sam, it can feel like a disadvantage. If the business underperforms, you can get portions of it back. We call that a leaky GRAT, and it's not a great way to do transfers to grandchildren. Also remember that when you do the GRAT, when the stock goes into the trust, you don't vote the stock anymore. The trustee controls the stock. So think about that. Okay, next slide, please. This just tells you why you want to think about doing this now. Like I mentioned, that 75/20 rate is only 0.6%. So look at the last bullet point. If your business can beat 0.6%, you're going to pass all that excess return to your successor gift tax free. Okay, next technique. We're going to talk about, next slide, please. We're going to talk a little bit about intentionally defective grantor trust. And the intentionally defective grantor trust is somewhat similar to the GRAT, but this is used more often, could be used with an outsider because again, it's a sale component versus all gift component. Again, it's an irrevocable trust. You can't change it. You sell the business to the trust for fair market value and you take back a note. Next slide, please. You do need to have a small gift component. Some people say 10%, some people say 1/9, but at least greater than or equal to 10% seed money, because nobody in their right mind, the IRS says, would sell a business to a trust that didn't have any assets. So you got to have something in there to kind of support their realistic, sorry, we actually have a landline and it's ringing now, the best laid plans. Okay, you say you have to have something in the trust before you go through with the transaction. The owner sells the business interest to the trust. You support this with an appraisal. You can use valuation discounts, and you need to do it at fair market value in exchange for a promissory note. And then again, the distributions from the business to the trust then do double duty to pay the trustee. The owner continues to pay the tax on the business, and then the trustee can distribute income and principal. Next slide, please. Here's a pictorial again, and this will be in my materials, so you can look at that at your leisure later. Next slide, please. Advantages, again, the business growth over that AFR passes gift tax free, and that's a lower rate than the 75/20 rate. It's not 120%. It's either the applicable federal rate at short-term, midterm, long-term, whatever the term of your note is. But right now, your midterm rate is 0.43%. Berenstein's predicting 0.48 next month. It shouldn't be too hard to beat that. Again, the income tax paid is a tax-free gift. Next slide, please. Disadvantages, the liquidity for the seed gift, and I'd also mention you have to have liquidity to be able to keep paying the taxes. Here's the big disadvantage. You're paying tax on income you don't receive, and that's not just the regular ordinary income. If the business is sold, you will be paying the tax on the capital gain. So that's a big tax-free gift. It's a little riskier. It's not blessed by statute. Next slide, please. Again, why do you want to do it? Go to that last bullet point. If you can beat 0.43%, the excess return passes gift tax free. Okay, I am out of time. I want to just remind you to remember to get a buy-sell agreement if you don't have one. If you have one, dust it off. Remember to begin with the end in mind. Think about your why before you start pulling out these great techniques. And for goodness sake, next slide. Don't be like this guy. This type's kind of small, but they're in the funeral home. He's in the hot dog stand that looks like a coffin. And the wife says, if I heard it once, I heard it 1,000 times. Margie, you'd say, when I die, the business dies with me. Don't do that. Thanks for coming. Make sure that you check the link. In the next few days, you'll get the full outline, some of those things that Ben's offered, and a copy of our slides. Thanks for attending.